Good morning, everybody. Thanks very much to everyone for joining us here this morning. Fantastic to have such a great crowd here at 9 a.m. On a rainy morning in London. Thank you to everybody also for joining us online. You won't have had the rain in London, so I'm sure it's warmer where you are in the rest of the world. Super discussion today. This is one of the kind of regular research pieces that I look out for at the start of the year. So we're going to start this morning just looking at the census. Kevin Mofid is going to take us through some of the key elements of that, and then we've got a great panel to discuss some of those things. And I'm also looking forward to your questions, both in the room but also online. For those that don't know me, my name is 𝗥𝗲𝗀𝗿𝗁. I'm the co-founder and head of content at Real Asset Media. We focus less on the news elements, but more on research, analysis, strategy, the kind of things that are driving the market rather than just looking back at what's happened. And because we're all together and it's the start of September and we've all had a good summer break, we're gonna applaud to welcome Kevin to give us the presentation. Kevin.
Good morning, everyone. Richard, thank you for the introduction, and thank you for so many people being here. I think this is the biggest audience we've had in person and online for now our fourth logistics census, pan-European, with Tritax EuroBox. It's also the biggest response to the survey we've ever had as well. So over 500 occupier responses, working with our research partner Analytiqa as well, and also over 100 responses from developers and investors. So we're really happy, really proud that this has built up a head of steam and is now becoming one of the go-to events covering the European logistics market. Now I'm going to be looking at my watch. If you've seen me present before, you know I like to throw loads of graphs, loads of stats, loads of charts, and kind of dazzle you with the content that we've collected over the summer. Now it's worth saying that the survey was done over the summer months, and it is a snapshot in time, but there's some really interesting points that come out of the census this year, which our panel will be discussing, chaired by Richard, in 15-20 minutes time. So firstly, a bit of shameless self-promotion. If you don't follow the Savills Industrial and Logistics space on LinkedIn, please do. We put all of our interesting research, buildings we're marketing, investment opportunities, a whole myriad of different things on there. That QR code will take you straight there, and you can. That's on all of the slides coming through. Now, to start the presentation, I always like to use a bit of imagery, and this was a bit of imagery I first used at Shed-Masters in Barcelona 2 years ago. And we were talking about where we are in the market cycle and on a bit of a roller coaster. And I used this image last year, and I'm using it again. You could call that lazy. But this year, I've added a little bit of animation just for a change. And somebody asked me where are we on the market cycle on this roller coaster ride, and I'd say 2023 we were probably there, just coming over the top. Where were things heading? How was the capital markets going to play out? Where was the occupier market going to settle? Where are base rates going to settle? And I think where we are now is approaching the end. The nadir point has probably been reached in certain markets, both on the capital markets side and the occupier markets side. So I've broken this presentation up today into three segments: a bit of kind of macro overview, then doing a bit of a deeper dive into the census, interspersed with some data on the occupational market, and then we wrap up looking at the investment market and the responses from investors and developers before we then head to our panel discussion. Now, as I say a lot at the moment, I'm not an economist. I trained as a town planner. But within Savills, we have a team of economists, and I've curated a couple of slides with particular relevance to the industrial and logistics market. And if I'd have had £1 for every time I'd heard the term soft landing over the last 12 to 18 months, I Could have taken Richard out for a nice lunch or something like that. But if we look at the forecasts, these are from the IMF. You'll take your own forecasts from Oxford, Capital, whoever. But there's been a steady, if inconsistent, volatility to the forecasts. But overall, we're seeing a revision upwards in terms of GDP forecasts, not just in the UK, but in many major markets in Europe as well. And the whole Eurozone, those forecasts have been revised up again on the GDP front. Now, again, we all know the position on inflation, and we've just put the euro area and the UK here in the context of the global markets, and you can see across the world we're heading back towards that 2% position, reaching its target, and obviously that will have an implication on the outlook for base rates, which in turn will have an implication for the outlook of yields in our sector, which we'll be discussing in the panel discussion. I put this chart up every year, and it's one of my favourites, and it's also really important. We're going to spend a little bit of time talking about nearshoring, reshoring, friendshoring, that sort of thing. But it's worth remembering that at a pan-European level, 2/3 of occupier demand comes from retailers in some way, shape or form. Now, that ebbs and flows in certain markets. Some markets have a slightly heavier balance towards manufacturing and industrial. But overall, it's the health of the retail economy that's really important to the health of the logistics sector. And this point about consumer confidence, this is a pan-European data set. And again, I mention this all the time because the health of the consumer is really important. We're just starting to see retail sales volumes tick up, and volume is an important indicator here because sales values, is distorted by inflation, and logistics, of course, is a volume game. But you can see with the red and the blue lines, people are generally comfortable with their own unemployment expectations, and they're generally comfortable with the financial health of their own household. Less happy about the wider economy, but that sentiment, I think, for people's personal lives is really important because it'll impact what big ticket items they're purchasing, their spending habits, all of that sort of thing, which then filters through to the logistics market. And I just wanted to talk a little bit about online retail. Again, a lot's been said about online retail over the last 18 months. Where's that heading? What's the trajectory? Again, we take forecasts from a variety of sources, Statista, Forrester, they all have different forecasts. So I thought actually this data set from Amazon was telling, which is the bar chart in red. Amazon sales were up 12.5% year on year in Q1. Amazon are taking space in the US. Again, that's going to filter through into the European markets as well. So I think, again, this is really important, and it's supported by demographic trends. Revolut, the challenger bank, they release a really nice data set on how much spending takes place on their debit cards, whether it's online or offline. I would guess that the average Revolut customer is of the younger demographic, and that is then around 40% of spending is online. So I think this is supported by demographic trends, and it'll play out again differently in different markets across Europe. But I think that trend is we're still comfortable with as a key driver for the industrial and logistics market across Europe. And then everyone loves a map, and this is a good one. Andrew and my team put this together, and the one thing I'd say is we've talked about supply chain resilience for years, and COVID really brought this into the boardroom. But as you can see with this map, there have been so many global geopolitical factors that have kept this issue in the boardroom. Some of them are weather related, some of them are conflict related, and some of them are completely out of the blue. The Suez Canal, the bridge collapse in Baltimore, all of this stuff is keeping supply chain resilience as a topic of conversation in boardrooms across the world. Now, how this plays out for the logistics property market remains to be seen. We think this is a slow burn, multi-year trend. And again, this will come out in the stats in a minute, and it'll come out in the panel discussion. Okay, Next element of the deck today is we're going to do a bit of a deeper dive into some of our survey responses, and then some of it is going to be occupational data from Savills research across Europe. You'll know if it's a response to a question because in the top left it'll say census data. So that's how you know that it's something that's been answered by our audience of over 500 major occupiers across Europe. A couple of market headlines just to set the scene, and these are stats from the end of 2023, so not taking into account the first half of 2024. And I'll put this in some context in a minute. 28.8 million square metres of take-up across Europe. New leases signed, not renewals, new leases signed. Vacancy rate. So we did have, during the COVID years, a record low vacancy rate across Europe of 3.2%. Since we produced this, actually, this is year-end 23, we're now at a 6% vacancy rate. So take-up is okay. You know, it's reasonable, and I'll put that in historical context. But we do have this issue of supply increasing in pretty much every market that we cover. So how's that playing out in terms of rental growth? How's that playing out in terms of what type of buildings people are taking? We'll discuss that again in a few slides' time. So first chart from the census. We ask this question every year. How do you view business conditions versus the previous 12 months? And the first thing to say, actually, is that if we compare this with last year, there is a definite shift in sentiment towards the more positive end of this graph. So we're seeing less people say business conditions are more difficult, and we're seeing more people say that business conditions are more favourable. And actually 53% of the respondents are on the favourable end of the spectrum of this chart, and that's a marked improvement from last year. We then asked occupiers two other questions. How has this impacted your expansion plans? Because what we really want to know is, is this a leading indicator for warehouse demand over the next few years within Europe? We asked a supplementary question this year about the timeframes of that expansion. And if we look at the pie chart first, a myriad of responses there, but actually, almost 3/4 of those responses we are still in expansion mode. We're just doing things at a slightly different pace than perhaps we were. And I think if you were speaking to our occupiers team, one of the things they would say is that a lot of occupier requirements in the market at the moment are for more strategic reasons. Maybe it's ESG, maybe it's tax, maybe it's supply chain efficiency. And again, I'm sure we can talk about that in our panel. But again, if we look at the bar chart, again, if you look at the yellow on the right-hand side, again, we're seeing an increase in occupiers saying, yes, we're not necessarily going to expand within 1 year, maybe it'll be 1 to 3. But that commitment to expansion is still there. And I think that probably will chime with many of you in the room at the moment, who are looking to do deals, particularly on the leasing side. And again, if we look at this in terms of our market data across Europe, actually it hasn't been a bad position. This is quarterly take-up by market. You'll be sent all of these slides, by the way. There's a lot of information to take in on here. I think what I would say is that Q1 was slower than we anticipated, but Q2 has been stronger than we anticipated. In the UK, for the first half of the year, take-up is 44% up year on year. And that's really important, because what we tend to see is when take-up starts to decline, the UK goes first. When take-up starts to rise, the UK goes first as well. So I think that's a really important indicator for how this may play out across the rest of Europe over the rest of this year and into 2025. And that's just the half-year figures, in a slightly more presentable way as a pan-European average. And what we've done there is we've just looked at the red line, and that's the pre-COVID take-up average for the first half of any given year. And again, 2024, all things considered at a pan-European level, take-up is 5% ahead of that pre-COVID average. So again, all things considered, a good place to be on the take-up side. One of the next questions we asked our occupier audience was, where do you expect to take more space? and what type of space are you going to be looking for? And again, this chimes very neatly with the data that we have on occupier requirements. If we look here, and again, this may come as a surprise given the economic situation in Germany and everything that's playing out across Europe, but Germany and France coming out top in terms of where occupiers are looking to take more space. Some other interesting points come out of this. If we look at Eastern Europe, Czech, Poland, in terms of the size of those markets, what's being driven by that? Is that a nearshoring story? Is that a reshoring story? So quite interesting to work out, what's driving between East and West and how that will impact take-up across Europe. We also then asked a question about what size of space are you taking? And again, this chimes very neatly with our take-up data and our requirements data. And the survey data is telling us that occupiers are going to be looking towards the bigger end of the size brackets in terms of how much space they are going to be looking to expand to. So I think Western Europe and bigger box logistics is what's coming out of our census data. Now, this is a question we've asked our audience every year. What's concerning you at the moment? What are the biggest challenges facing your logistics property operations? And it'll probably come as no surprise that cost pressure is right at the top. If we look at these, and again, there's a lot of information to take in on this chart, but if I just pick out some of the ones at the top, rising rents, cost pressures on energy and labour. Two other points, again, which we'll probably explore in the panel: access to power and the permitting planning process. These are perennial issues that always come out. So I think this is really interesting. One other point to note on this chart: when we first did this 4 years ago, almost at the top, occupiers were saying the lack of buildings was a real problem. Now, that's much lower down the hierarchy. Just 14% of the respondents saying a lack of supply was an issue. So that again chimes with where the vacancy position is. If we look at this chart, again, we've seen the pan-European average vacancy rate rise to just shy of 6%. But what that masks is pan-European market differences. You can see, a very different vacancy position. Some markets, Czech Republic, Ireland, still hovering around that 2% vacancy rates. Other markets edging towards the 10% vacancy rate. Now, the point to make on this chart as well is that, yes, we've seen vacancy increase, but the pace of that vacancy rise is starting to fall. So we're not beginning to see, this exponentially grow. We're seeing it start to tail off. And for occupiers, I have some bad news, because right at the top, we had this situation where occupiers are saying they're concerned about rents, they're concerned about costs. If we look at our pan-European rental index, which is the line graph, you can see, again, we can see rents increasing year by year, quarter by quarter. And we're now at almost 6% as a blended pan-European average for prime quoting rents growth. And that's really interesting, because if we look at this chart, and I'm not sure if the laser will pick it up on the screen, no, what this chart shows us, the scatter graph, if we plot the relationship between increasing vacancy and rental growth, history tells us that as vacancy increases, we should expect rental growth to decrease. But actually, if you look at that dotted line of yellow at the top that culminates with the big green dot, that's Q2 2024. What we are beginning to observe is almost a decoupling of this historic relationship between increased vacancy and lower rental growth. What's driving that? Is it build cost inflation? Is it a flight to quality? Is it a lack of supply in certain markets that are then driving up rents? Is it the issues that we've had funding build to suits? A whole myriad of different factors could be at play here, and perhaps we can discuss that in the panel discussion. But I'd certainly say that this is slightly anomalous in terms of what history would tell us between that relationship between vacancy and rental growth. Now, we ask occupiers then, what are they investing in? And if we look at the two charts here, some really interesting points come out of this. And two I want to pick up. If we look at what supply chain technologies do you intend to invest in over the next 2 years, we can split this out by retailers, manufacturers, and logistics companies. What you can see, a couple of trends I think that are important to note. We've known about the story for robotics and automation for a while, but this really comes out across the board in our census this year. But then just the far right of the bar chart, we can see a little bit coming through about predictive analysis, optimization, AI. So again, this is feeding through, and that's going to have a filter to the data center market and other types of industrial uses as well. But again, if we look at the how do you intend to evolve your supply chain model over the next 3 years, right at the top, and this was never there before, right at the top is investing in less CO2 intensive transport, EVs, hydrogen, those sort of things. So again, if we look at warehouse automation, robotics, AI, reducing your fossil fuel fleet, this points to power, being a key issue moving forward. Again, we've talked about this for years, but this I think is really coming out of the census now. And then I just want to talk about nearshoring, reshoring. If we go back to the survey last year, this came out really high. This year, we've got things like diversify your supplier base. So, changing the geography of where your suppliers are. That's at the top. But actually, companies committing to nearshoring, changing the way their supply chains work. This year, that's near the bottom. And cumulatively, that's around 6% of the responses. However, when you scratch the surface of that data, that 6% of occupiers who are saying they're going to nearshore are actually disproportionately larger occupiers. These are big corporates making big decisions. So actually, their impact on the market is going to be disproportionately higher than if it was a collection of smaller companies that made up that 6%. So again, it's really interesting. Now, our report that goes with the launch of this paper is going to be released later today. That report goes into real detail on some of these trends as well. So I think this is really interesting in terms of how it's going to impact the market across the next 10 years. And again, in the UK, where we've got the most granular data on the occupier profile, I just want to draw your attention to the yellow in the bottom right. So we group together our take-up by different occupier types. Manufacturing, retail, other. What you can see here, the manufacturing element, which is the yellow, that's ebbed and flowed over the years. But actually, post-COVID, we're just beginning to see this increase in take-up that's related to the manufacturing element of the occupier pool. Right at the very top, again, 3PLs in the sky blue, I guess. That's really interesting as well, because there's a lot of noise about the health of the 3PL sector. Cost pressures, administrators being called in, so on and so forth. But actually, in Q1, 53% of take-up was related to the 3PL sector. So they're still very, very active occupiers. So again, I'm sure we can talk about that in the panel. We asked our occupier audience what is on the horizon that is going to be game-changing for logistics real estate moving forward. And the eagle-eyed of you will note that this doesn't add up to 100%, but this is people could select multiple options and almost rank the options that they had available to them. But again, if we look at that blended response across Europe from our occupier base, what we are beginning to see, and this has never really come out in our census before, but right at the top, number one, what could be game-changing? More stringent ESG targets and regulations. So again, we've had this dichotomy in the census before, where our investor audience and developer audience are saying ESG is right at the top, in terms of how we want to invest and how we want to build. And for occupiers, it was pretty much near the bottom. But this year, for the first time, it's coming out as a game-changing factor for logistics real estate. And again, if I talk about that power point coming out number 2, robotics, automation, all of that sort of thing is coming out at the top. And that's going to have an impact on the buildings we develop, the buildings we want to disinvest from, the buildings we want to invest in, and so on and so forth. Okay, last part of the presentation is more about the investor-developer audience who responded to our census. Okay, and again, if we go to our developers first, power and planning, again, if we look at 2 things here, and I'm going to do the bar chart first, rate each of the following issues in terms of their level of importance when considering new developments. Lack of development sites was a big issue last year, not so much this year. Still near the top, but its relative ranking has decreased. Right at the top, the length of the permitting process. When I speak to my colleagues from across Europe, this doesn't really change no matter what market you're in. We often ask the question, what can we learn from other countries? It would seem the answer is nothing. When it comes to this planning process point. But again, if we look, power right at the top, availability of finance and debt, and then we have some more practical issues about yards, doors, height of buildings, so on and so forth. We also asked another question, do you plan to develop more, less, or the same in terms of speculative development over the next couple of years? And again, what's interesting here is we've only got a quarter of the developer audience saying they expect to speculatively develop more space. Most are actually saying less or similar. So if we have similar levels of take-up over the next 12 months, and if the development pipeline starts to shrink, this would point to the vacancy rate starting to come in again over the next 12 to 18 months. Maybe another couple of quarters of expansion, and then into 2025, all things being equal, we would expect the vacancy rate to start dropping as a blended pan-European average. Now, of course, different markets will perform in different ways, but again, I think that's an interesting point that comes out of the census. Moving on to our investor audience, what are the biggest factors impacting in the investment market at the moment? So what we're looking for here is yellow, and these are the very important factors. And again, this will probably come as no surprise to the investors in the room and investment brokers in the room. But 2 of the things that are coming out right at the very top, pricing aspirations, so buyer and seller spread, and the availability and price of debt. So some interesting points there that again we'll discuss in the panel discussion. Investment volumes 24% up year on year. I think we'll be heading closer to that 40 billion euro mark by year end, given a strong last quarter. And again, the last point I want to make is about the total element of warehouse investment when compared with all other asset classes. And what you can see here, that structural story that we've discussed is really important. And logistics and industrial accounting for 24% of all commercial real estate investment so far this year. The highest level it's ever been as a proportion of the total investment market. We asked our investors where they'd like to invest, which markets. And interestingly, this is broadly aligned with the responses that we got from our occupiers in terms of where do you expect to take more space. So this is really pleasing. Again, France, Germany, Spain, Netherlands, UK, core industrial and logistics markets, liquid markets, big markets. So I think that's really interesting. Last point on pricing, we're just beginning to see that tipping point. Some markets are steady with where their pricing is, but again, as a blended average, we've seen prime yields come in by 3 basis points in Q2. Now, not a big shift, but I'm sure we'll be discussing that in the panel. So, to wrap up, I was asked yesterday, how positive am I about the market? And look, I'm a glass half full kind of guy. I like to draw out the positive points from the census. But I think there are a couple of things we should flag, and we'll discuss that in the panel. We do have a position where vacancy and supply has increased. we do have a situation where occupiers are saying, yes, we want to take more space, but maybe we're delaying that expansion. And we do have a situation where occupiers are saying we're concerned about costs. But overall, we can see a reasonably positive outlook for the industrial and logistics sector across Europe. Occupiers are still in expansion mode. They have big strategic things on their mind, and the capital markets and development community are aware of those. And hopefully this set of results has set the scene for a nice panel discussion now. So thank you very much. I'll hand over to Richard.
Thanks, Kev. Really interesting. So if the speakers could join us now, that would be great. Really interesting topics there. I think a lot of things to pick up from. And for those of you in the room, but also everybody online, those slides will be sent to you afterwards if you registered. And they'll also be available on our website afterwards. So don't worry if you can't remember all of the things in terms of the difference in. Particularly the global one was the one where there were about 40 different topics on that one. So let's start with introductions. I've already introduced myself. So let's start with you, Carl. Just quickly, just 30 seconds on yourself and the company, and then everybody will gradually know who everybody is. Carl.
Sure. Okay. So I work at Sunrise. We're a pan-European logistics platform. As I say, we're an investor, developer, manager of logistics assets. And I head up the acquisitions there.
Great. Douglas.
Douglas Anders. I work out of our Savills Amsterdam office, and I'm responsible for the logistics and industrial team with a focus on investments.
Great. And Henry, and just before we start on this, I know there were very big news yesterday in terms of Tritax EuroBox and 𝗥𝗲𝗀𝗀𝗍, and I know you can't say anything about that, and everything was covered in the press release yesterday. So because we're going to be quite efficient, there's no point asking any questions on that, because I'm pretty certain Henry will say I can't possibly comment. So let's not waste our time on that. Henry.
Thanks, Richard. I can't even blame Savills for the timing, because once I say Henry Stratton, Head of Research at Tritax Management. We're obviously investment in logistics, Tritax Big Box, Tritax EuroBox, and some private funds as well.
Super, thank you. And last but very much not least, Peter.
Hello everybody, I'm Peter Schuijlenburg. As you can all hear, I'm Dutch, one of the few Dutch in the room next to the other Dutch guy. I'm working for a tiny logistics company called DHL. Within DHL, I'm responsible for the real estate development of supply chain within the EMEA region.
Great, let's pick up. And just a reminder that if you've got any questions, raise your hand, stand up, shout out, whatever is necessary, that I can see that you want to ask a question. And online, obviously, just put it into the chat. I'm monitoring that, and I'll try to make sure that your points are also brought up as well. Let's start, first of all, maybe with you, Henry. Just in terms of your, I suppose, your take on the census, the results, and what were the standout points for you? Were there some things that surprised you? What was your take on it overall?
Yeah, I think overall sort of two things probably jumped out to me. One, sentiment, I think it was really interesting. So improved from last year, I don't think it's a surprise, perhaps more reflection actually on where it was last year, given that a lot of expectations were we were sort of heading into recession at that stage. So good to see that picking up. I think notable that it's on the slightly improved side, and that feels sort of very consistent, I guess, with what we're seeing in the market in terms of occupier position. There's a lot of caution still in the market, that certainly hasn't changed. A lot of I guess caution in terms of moving forwards, but it was really good to see the kind of medium-term outlook still there for expansion. I think the second thing with that which jumped to me was actually how few were saying contraction's likely in the next year. I think just 1%, and it really feels like this kind of post-pandemic shakeout now is complete, and we're through that to a greater extent. So I think that was the first thing that really struck me, and then the other one just quickly was on the ESG side, seeing that kind of top of the tree from what's on the horizon. There's a lot going on around this, and it was notable that was ESG and regulation, not just ESG. And I think with what's happening both in Europe, North America, globally, around trade, around carbon, etc., we're seeing more and more on this front. And we're not really necessarily seeing kind of specific requirements in terms of what needs to be delivered. So We're seeing EU-level mandates being actioned at a country level. I think a lot of uncertainty there, which is why that sort of sits on the horizon so much for occupiers. They know more is coming. They know more is going to have to be done. We've got challenges around development, for example, in France with new rules there. We've got carbon taxes potentially coming into play. And I think that everyone knows that's something which is going to continue to grow over the next few years, and it's something that they're going to have to address over the next few years. So that really struck me sitting at the top of the kind of on the horizon list.
Okay, good. And Carl, it might be interesting just to pick up from you as well, your kind of first takes on what you've seen here.
Well, very similar to what Henry said, the sentiment really is quite positive and feels nice as a developer because if you want to get anything done, obviously it was very difficult to do that in the last 2 years. And then just in terms of the game changers that everybody agreed on being on the horizon, ESG, to echo what Henry said, but also the increase in robotics and automation and the impact that will have on our industry going forward as well.
Yeah, it was interesting to see how that's changed as well over the time, I think, Kev, as well, in terms of that. And Peter, just picking up from you, you're coming from a different perspective, obviously. So I guess what were the things that you particularly picked up on? I'm going to drill down into the ESG part as well later.
Yeah, well, to start with, I think many of our goals are pretty much aligned with what the developers and investors do. You know, it's all very high on the agenda, the points that I saw in the census. So things like ESG, post-productions, resilience, it's especially the resilience word that I saw very often in the text, and this is one of our, I think, key challenges being a service provider. We need to follow our clients, we need to serve our clients, and it's obviously the clients' their goal to to secure their supply chain. This is one of the big drivers also of our business. It's also driving the geographical spread, because what we see is clients moving into other countries to secure their supply chain, changing their routes of transport, and we have to follow them in a way. And that is a cost factor. It means we have to look for new locations, build new warehouse facilities, moving out of old ones, and making sure that the new ones are ESG compliant.
Okay, great. And maybe Douglas, just picking up from your point of view, I guess how do you see some of those trends and how are they developing? Because you've obviously got that European view as well.
Yeah, I think it's interesting to see that the whole power sort of scarcity is now also feeding through in other countries in Europe. I mean, in the Netherlands, we like to be, let's say, first in line, but I think on the power capacity, we hated to be first in line. It's been a problem for a few years, and I mean, if you look at a map of the Netherlands, I think there's about 80% of the country where there's simply no power available, which is becoming a big issue, and I think a lot of people have underestimated that, especially in the Netherlands, and I think within Europe, it's now becoming more of a known thing, and hopefully you can anticipate, but because it is a problem which is difficult to solve.
Okay, I'm going to come to that ESG side, but it would be interesting just to pick up from you as well. You're based in the Netherlands. It was one of the hottest kind of markets over time. How are you particularly seeing that market? Also, because from a personal note, I'm going to be in Amsterdam running a session in about a week's time. So,
there's two sides of the table. I think from an occupier perspective, we've seen take up similarly to last year, probably a little better, which is a good thing. I think the most important thing we see on the occupier side is that there's simply no new supply coming. So we have to look at brownfield redevelopments, which of course takes longer. You need more plots to actually get to a bigger building. And then the whole problem from power comes into play, nitrogen issues, a lot of resistance politically for fighting for land, for either housing or logistics. Housing now wins because it's simply a bigger problem. And I think on an investment side, it's been, I mean, it couldn't be worse than last year, so it's been better. But to be fair, I think we're slowly seeing a lot of investors that were in a holding pattern or waiting to see what happens. They're now slowly coming back to the market. I think the value add and the core plus market was still quite active in the first half of the year, and I think we're going to see more institutional core funds coming back. So there's definitely a few deals which are currently on the market in exclusivity. Hopefully they'll close and give us a little bit of market evidence. One delaying factor is that the government is now it's leaked that they've decided to lower their rent back down to 8% in the Netherlands, which will probably have a delayed effect, which is on the one side a positive thing, of course, that it's going down, but on the other side, it's a bad thing because then all these deals will get delayed, which will sort of cause a delay in market evidence, and therefore for the people to have that evidence to actually do deals.
Okay, good. And it'll be interesting. I'll drill down into those markets as well that we're seeing elsewhere and where we can pick up. But just everybody's mentioned the ESG side, so let's take your pick on that, I suppose. I guess what sustainability measures do you think are the most important? How do you see that? And feel free, anybody, to pick that up from your own perspectives, really.
Yeah, I can take that. So I think the big change this year, obviously with sort of EPC equivalents coming in now across Europe, but inconsistency in terms of how those are tracked, recorded, on letters, how is it going to be rated? So this is where I think so much is still sort of worked through on this front, because it's difficult for investors, it's difficult for everybody to get a handle across different markets in terms of what comparables look like. And so, I think on this at the moment really it's all about actionable and what's deliverable, and again that came out in the census. So last year obviously the energy aspect was a really high priority, clearly with what was going on in terms of energy costs. This year it's more about efficiency, and that's where we're sort of, I think, seeing the real sort of near-term opportunities. What can you do within your existing estate to improve efficiency? How can you make it more energy resilient, etc.? How can you shift the dial on this front with really actionable capex spend that delivers returns for you? Then you've got some of the long-term challenges around power, for example, and not only access to it, but connecting the last mile to it is so difficult. The evolution of power generally in terms of it being created in different locations where we now need it. And so I think it's this kind of two parts. One, reporting aspect that's particularly difficult, and then secondly, what's really actionable for occupiers to deliver that as a building owner you can work alongside them, to really kind of enhance that overall offer.
Okay, good. Who else wants to pick that up? I know DHL obviously doing a lot of work there, but Carl, feel free to pick it up.
Just one aspect to add on the developer side, obviously you need to take into consideration biodiversity when you're looking to tear down forests and build new warehouses. So I think something like 70% of biodiversity has declined over the last 50 years due to loss of habitat, and obviously that trend can't continue. So we try to address this with our new developments by replacing some of that lost habitat with replanting trees, shrubs, flora, getting creative around landscaping, adding birdhouses, beehives, things of that nature as well.
Yeah, it's interesting how biodiversity has come to the fore a little bit more as well. Yeah, Peter.
Yeah, so I can only stress that ESG is a cornerstone of our strategy, right? It's in our strategy we want to be carbon neutral by 2050, which is still a long time out, but there's still a lot to be done. Part of the strategy, the short-term strategy, is that we are not supposed to take leases in buildings that are not carbon neutral, which puts an enormous burden on our business, because it would mean basically that they would have to move out of older facilities into new facilities that may not be there on the locations where we need them. So we are working together with landlords to invest in those buildings that are not yet carbon neutral. Either we do it ourselves or the landlord does it, and so there are ways to work around it. But part of my team is to develop carbon neutral warehouses, and that's one of the highest priorities that we have.
Okay, all right, interesting. And yeah, Henry,
I was just going to say to build on Carl's point as well around the B&G. I mean, there's a real supply issue here coming, I think, over the next few years. Kev's numbers showed it, I think, to some extent, but drilling down into specific markets, we've got some real differences now emerging in terms of where vacancy rates are in particularly kind of core markets, think down through the centre of France, down to the Rhine-Ruhr region, past Hamburg, for example, very little available. In contrast, some of the second tier, third tier markets, that's where a lot of development has come, and that's where we're able to do a little bit more. I think all of this is going to play to a really interesting dynamic in the years ahead as it gets ever more difficult to bring forward new products at a time when occupiers clearly still seeing this evolution towards higher, larger, more efficient space, and that's really critical part of this. They need to bring more productivity to their operations, and the warehouse network is a huge part of that. So we've got this, I think, real challenge coming for the industry kind of now as we move through the mid-2020s towards some of these targets for a supply picture and what that does for markets overall. And I think it will create some real divergence between performance in different markets.
Okay, good. I wanted to pick up a little bit on the macro challenges. We saw a little bit there about, it was interesting that point, I think, about retail coming back, manufacturing coming back. I suppose, how are you seeing the general picture? Kev was glass half full. So where are you at the moment looking at that macro side? How do we see the market?
Look, I think a big part of, let's say, the downturn that we've seen was the volatility that was in the market. Now, of course, it seems to be sort of getting more stable on the political front, also hopefully across the globe, which will probably help in both investors and occupiers being able to sort of write their business plans again with a sort of an outlook which they can rely on, which is probably going to help.
And I guess, how do you see that as well? Anybody, in terms of the challenges, opportunities, how you've had to adjust potentially?
Yeah, so then on the macro one as well, I think a couple of things. So obviously, at a consumer level, very different picture this year, still under significant pressure, but obviously we've got earnings growth now exceeding inflation, so you're seeing some benefit in the net element there. Totally different picture to North America in terms of spend over recent years, consumer in a much better place. So kind of underpinning it all is a better picture. However, the spend, whilst creeping up, isn't really releasing perhaps to the extent that we'd like. I think the other thing to this is how corporates have performed over recent years. We've seen some real divergence between corporates in our sector. I mean, the transport logistics 3PL space is probably the best example. A top tier who have done extremely well, improving margins, generated great profits, huge outsourcing trends over recent years, kind of doesn't get talked about nearly as much as e-commerce, etc. You've got this group totally differentiating in terms of what they're able to do, how they're operating, funding the capex, which they have the balance sheets and capability to do, and that's translating through into much more efficient operations. And so that, I think, then is reflecting through in terms of how it sort of looks going forward, because this group is still very much on the front foot in terms of looking at how they make those medium-term adjustments, which of course is what a lot of these requirements are around. I think just finally on that, it's the mid-tier and the lower tier, particularly in spaces like the 3PLs, where there'll be a really interesting shakeout still to come. More consolidation expected in that space. If they don't have a particular niche or the ability to make the kind of investments that the leaders do, it will challenge their operations. So they're going to have to find or extend the existing roles they have in terms of what they do in the market. And so they've been very active over the last sort of 12 months or so, particularly in 2023, taking space often in the secondary markets, a little bit cheaper, etc., kind of pulling the levers that you typically see them do. And so I think how that goes sort of the next 12 months will really sort of impact the take-up numbers and activity on the demand side.
Okay, good. Does anybody else want to pick that point up?
What I can add maybe to that is that what we see with our clients, and many of our clients are large corporations, is that their behavior is based on mainly three elements, which one of it is cost efficiency, the second one is ESG, and the third one is securing their supply chain. As a result of all the turmoil that we had or still have, these are the three key drivers, and as a service provider we have to follow them in those three elements, right? So a result of that is that we see clients diversifying in other regions in the world in order to secure their manufacturing processes. So clients that used to manufacture only in Europe are now setting up different manufacturing plants for example, in Vietnam or in Mexico, and as a result of that, we would have to follow them in those regions and building warehouses there that are ESG compliant and fulfill all the other elements. So it's really those three elements that are also a key driver of our own growth, and we are growing as a result of that. So.
Okay, interesting. It might be interesting, Carl, just to pick up with you. We haven't talked much about interest rates. But there was, of course, in the survey there around the availability of debt, price of debt as a key consideration. So I suppose, how's that market performing, and how is it impacting your investment decisions?
Certainly. So when we talk about the macroeconomic outlook, obviously we've just seen the first cuts from the central banks, Central Bank of England, and now we're expecting the cuts to come in the U.S. next week. Clearly, we've had 2 years of elevated cost of financing, which has made it very difficult for equity investing across the board. Sellers have also been reluctant to accept pricing cuts over the 2-year period. But one thing I would say is that this these increased interest rates pushed many fund managers to start raising private credit funds. Those credit funds need to invest, and we started seeing that liquidity come to the market around the end of last year, beginning of this year, particularly for opportunistic and value-add opportunities. So at least in the investments that we do, which tends to be on the opportunistic and value-add side, we started seeing those terms improve relative to what we saw, let's say, at the end of 2022 or 2023. And now with interest rate cuts and a more favorable forward curve, I'd say investors are able to start bridging that gap with some of those pricing expectations, and you've seen that so far this year in the market, particularly with some of the larger fund managers.
Okay, good. Let's pick up a little bit. Maybe let's look, Doug, at the kind of the investors side of this, because 52%, I think it was, of investors in the survey said they expected investment volumes to increase. So I guess, what's your take on that? Do you agree with the sentiment? Do you see that coming through? What's your take on it?
Yeah, I think as I mentioned before, the investment volumes were super low in 23, so it can only get better from there, I would assume. Agreeing with Kyle, looking at the forward curve of debt, it's definitely going to help. I mean, we've seen swap rates go down quite substantially over the past few weeks already. Expecting those cuts to really come through, making it more easier to bridge the gap. I think in a lot of countries, such as the Netherlands, where we've seen substantial rental growth, of course, it was easier to bridge that gap than other sectors. I mean, comparing it to an office market or a residential market is very different. I think if you look at, for example, the Netherlands, logistics remains the biggest investment sector for the first half of the year. And I think that will probably remain the same, especially now with that core capital returning to the market. There's definitely a few developers who have developed buildings but have sat on them because they weren't able to sell at a price that would give them enough upside. That's now sort of changing with the rental growth coming through and also the core capital coming back. So we expect definitely more volumes across Europe, to be fair.
Okay, good. And let's pick up a little bit with you, Peter. I mean, you know, there was also rent rises we were talking about, which I guess you're not so keen on. What are you seeing that? I guess, how do you see that as a key issue, obviously, you know, for occupiers in terms of their cost base? So I guess, how do you see that? Is that leading to difficulties with lack of space? What are the kind of drivers for you? How are you, I suppose, how are you adjusting to that? How are you seeing that? Do you expect that to change? What's your position?
Well, I think the big question for everybody in this room is how sustainable those increased rents are, right? In my perspective, they are mainly the result of higher cap rates that we have seen. So my expectation or my hope would be that when cap rates come down, developers would have more room to offer also lower rents in a competitive market environment, right? But when will it happen? I don't know. Nobody knows. So we have to adjust for the time being to those higher rental levels. There's no way around it. When we are developing ourselves, we have to adhere to market conditions as well. And of course, our colleagues from the business don't like that because they, especially when they have to move out of an old facility where they had to pay €4 per rent per square meter per month and to a building where they now have to pay €7 or €8 a month, that hurts. But what is the alternative? The alternative is to stay where they are. If the building is non-ESG compliant, they're not supposed to stay in a building. Can they move to a building with lower rents? Really no, because either the landlord is stupid or the building lacks the specifications that we need. But do we lose business as a result of that? Yes, in some cases we do, because we are not competitive, and we have to give up on certain RFQs. So we see that happening in Eastern Europe, for example, where there still is a big gap between yield expectations. So if yields are at 7%, there's no way as a developer that we can offer a rent of €3.5 or €4 per square meter per month. And the business would expect that. And then we come back and say, well, you have to pay €6.5, and then they say, well, then we can't do the deal. So it is the hard result of that imperfection.
Just to add to that really briefly, what I would say as a developer or an investor, if you're not baking in rental growth to your underwriting, you're just not active in the market. You can't do deals, and you haven't been able to for the last 2 years unless you believe in the rental growth. So you're going to hold out for the higher rents if you've invested in the property, developed the warehouse for as long as you can. So I think it will take more vacancy building in the market to put downward pressure on rents, which I don't think we're going to see, because also not all vacancy is equal. I mean, we didn't dive down into the stats, but clearly, if it's grade C, grade D product, you'd expect there to be a lot more vacancy.
And maybe, I mean, just for me, I'm just wondering, of course, we've seen rental growth, and of course, we've seen occupiers become more efficient in the space they have, and I think with the lack of space or lack of land, for example, in a few countries, especially on those historic, let's say, hotspots where there's a lack of space, there's still a lot of demand in those spaces. So I think, as an occupier, when you can be more efficient in newer warehouse or existing warehouse, there's also room to pay the higher rent. Or is that not correct?
Well, we have to deal with the situation, and so it was one of the 3 elements that I mentioned earlier with our clients is cost efficiency. So we try to create and achieve cost efficiencies in the warehouse that we operate through automatization, through digitalization, in order to compensate for some of that cost increase that we face on the property side. Yeah, the rent is only one part of the total cost picture. But it is an important part, and if that doesn't change, we have to find ways to increase cost efficiency overall, which is something we're working on as we speak. Yeah.
Okay, good. Henry, I just wanted to pick up with you. We've mentioned a little bit there about spec, what occupiers are looking for. Have you seen any changes? Are you seeing any changes in general in terms of the demand for spec that you're being asked for? What's the situation?
Well, I think it's exactly what Peter's saying there. If you want to achieve those rents, the spec's got to be spot on to be able to create efficiency and productivity. So we've seen buildings getting larger, we've seen buildings getting higher, but it's also bringing in the ESG component. So what are you offering in terms of simple things, canteens, etc., areas that historically haven't been in focus, but have become particularly important now for companies trying to attract and retain labour in a market which is not as tight as it was 12 months ago for labour, but is still very important. And I think the challenge will really come where people compromise on these things: yard sizes, access to buildings, safety, all of these different components, even buildings themselves in terms of densities on plots, etc. Any compromise here is going to, I think, become a real challenge going forwards in a market that's a little bit more normalised, I think, in terms of vacancy levels and rental growth going forward than perhaps what we've seen over the last couple of years. So I don't think too much in terms of specific change. I think it's more about recognising what occupiers are trying to achieve by making this move, and it's absolutely critically important that the building facilitates that.
And are there different challenges, Henry, as well? If we look at geographies, for example, we haven't really mentioned geographies yet. Are there different challenges there, let's say, Southern Europe, Eastern Europe, Western Europe?
I think quick answer to that, it's more on use and how that space is going to be used. So are you going to high bay with automation around it? Are you going to use a sort of Amazon-type ARS system? Are you going for a more traditional use, and therefore you don't need the height? So I think now it's much more about what the requirement is. Manufacturing, as Kev talked about, on the rise, on the increase, typically comes with a lot of specific requirements around it, given how that space is going to be used, and you've got to factor that into the investment proposition, recognise what the reuse of that space might look like. So I think it's really understanding, making sure you understand exactly what occupier you're attracting to do what in that building, what that group looks like if you're putting space in the market.
Okay, good.
Sorry, actually, Richard, just on that, one other thing that Europe's got a big advantage on is the later stage of the e-commerce boom. I think is proving quite beneficial because there's much more visibility around what the requirements look like for those operating that kind of space. So, we've seen places like Italy, for example, where that e-commerce number is starting to tick up and hit levels. Actually, what has been built in those markets and what's being operated in those markets is some of the best, I would say, buildings and operations globally, because companies have had the ability to look elsewhere, learn the lessons of what they've done in the UK, North America, etc., and apply those in terms of how they want to use that space. So I think, again, Europe's got a bit of an advantage on that front from things like the kind of ongoing e-commerce growth.
Okay, good. And Carl, it might be interesting just to pick up with you, and if anybody else has a view on this as well. If we were, I was in Warsaw along with Ian actually here at the front for the CE Summit. lot of discussion, a lot of enthusiasm and appetite for logistics, both from an occupational side, but also from the macro kind of point of view there. What's the position here? Because obviously there's a lot of investment into Western Europe. So I suppose what's your take on CEE, Poland, the influence of the war with Ukraine, those kinds of things? How do you see that?
Sure. So firstly, we only invest in Poland in terms of CE markets, so it's tough for me to comment on anything outside of Poland. But what I would say is, as far as the conflict in Ukraine is concerned, clearly the market has a swift and heavy reaction to it once it happens. But unfortunately, these things over time start to become normalized, and the market and corporates and their investment in business decision making just price it in. So at this point, 2 years in, I think it's largely priced in. I think most corporates or investors that are steering away from Poland or CE is more likely due to market fundamentals than the conflict itself. We've paused our own investment in Poland since 2022, and that isn't driven by the conflict in Ukraine. That's purely based on market fundamentals and us seeing better risk-adjusted returns in core Western European markets. I think absent the conflict in Ukraine, that probably would have played out similarly if interest rates had raised and we'd be in a similar environment to the one that we're in today. That said, our Polish portfolio has actually performed quite well on the occupational side. We've seen very buoyant leasing. In fact, it's been our best leasing market in the last 12 months. Part of that's also driven by shorter leases, so you expect to see more gross take-up if it's 3 to 5 year leases, but we've had about 90% renewal rates. We've signed over 100,000 square meters of leases in the last 12 months. So we have seen many large corporates decide to enter the market and expand their footprint there despite the fundamentals and what's going on in Ukraine.
Okay, good. And I guess, thank you for that, Carl. And Douglas, if we're looking at your side, the nearshoring trend was mentioned. How do you see that playing out? Do you think that's going to play out more, for example, in Central and Eastern Europe, Southern Europe, than in Western Europe? What's your take on that?
I think with there being more space there, it'll probably have an effect. And of course, I think there's a little bit of a learning curve there for investors to sort of follow the occupier market. I think what we have seen is when there's a lot of volatility, a lot of investors go back to their historically strong markets with strong fundamentals, as Carl also mentioned. And that's exactly what we've seen, right? I think if you look at where investors have been, they've been in the key markets, so that's Germany, France, Netherlands. Those markets have remained quite resilient even during the downtime that we've seen. And I think with occupiers now looking further into the rest of Europe, into Poland, CE, those areas, I think as soon as occupiers seem to be confident or are confident to be there, we expect the investor market to follow. But it will only happen when there's less volatility and more stability, because as long as there's not enough stability, they will remain in their core markets.
And do you think there's a mismatch at the moment between those occupational markets and the investor demand, and maybe there's, for different types of investment capital, there may therefore be more of an opportunity in those areas?
Yeah, I think there's a little bit of mismatch because there's always a sort of lag effect. When occupiers do something, investors tend to follow, but it takes time for them to follow those occupiers. So I agree, I think there's a big opportunity there if you're able and willing to take the risk to invest in a market which isn't as established as the Western European markets. I think there's definitely a good opportunity to, if you're first, that you could make a very good decision.
Okay, good. And picking up on that nearshoring, reshoring side, Henry, I mean, I noticed this year the results in the Census had less emphasis on that, but actually the companies looking to reshore, were larger. So does that mean the requirements will be larger? Are you seeing anything in terms of the market that's suggesting this already, or is this something where the Census is predicting what's going to happen? What's your take on it?
Yeah, so investment-wise, we don't get past Poland as well. We haven't done historically, but I think just in terms of what came out there in reshoring, I think a couple of things: reshoring, nearshoring. There's so much to this that is complex in terms of that high-tech industry, chip manufacturers, automotive. That's coming back to the likes of Germany, Western Europe.
this isn't driven by low labour costs and what we've typically outsourced around in the past. This is about the huge evolution that's going on in global manufacturing. So there's as much happening on this front for your big Western European markets, I think, particularly Germany, actually, with some of the challenges that country in particular faces right now, as there is for the likes of Panasonic, Goodyear going to the Czech Republic. It was interesting to see that come out quite high in terms of where people think it might go. I think the numbers in this maybe can be a little bit misleading, because these are huge decisions that companies are making. This is not like the ESG issue where everyone can see it on the horizon. This is board level strategic capital allocation around how you rework your supply chain, with significant costs involved and huge disruption to ongoing operations as you process this. So we shouldn't really expect it to almost be too much at any one point in time. I think you said it's sort of slow burn almost, and that's exactly what I expect to see on this. I expect it to lift manufacturing take up across those core Western European markets, particularly things like chips with incentives around it. And then I think that some of these Central and Eastern European markets are clearly going to be beneficiaries as well, given the opportunity to locate, for example, Czech Republic and go that way. So I would see this as a slow burn adding to the other drivers that have been taking the market forwards. And rather than just thinking e-commerce reshoring, it's actually going to be the kind of intricacies of those individual decisions around companies, different product types, of where you move that to and how you make that work, which is then going to have the knock-on effect to drive demand in our sector, and all the 3PLs that follow those big decisions. Last word just on the EV side of it. Again, almost entirely new supply chains being built around the development of these products. Just seeing 100% tariffs now in Canada, for example, which will have a big impact on EV imports from China. Europe not there at those levels, but we're seeing this kind of evolve. And so again, it's not just the main entity moving, it's all that follows this and the kind of spill-out effect that has, which will be really exciting for a lot of markets, I think, over the next years.
Okay, good. I just wanted to pick up briefly, Peter, with you on the ESG side, which, as we mentioned, there is a growing topic. But what are the aims for you in terms of your portfolio, and I guess how are you managing that? Because I think it's till 2025 you've got a goal to be able to have dealt with that. But obviously, where are you on the on the path to that, and how are you seeing that progress?
Yeah. So generally, according to the stats I have, more than 1/3 of our buildings globally is already carbon neutral. So we are on a good way. The 25 goal is for our supply chain and mainly related to buildings. So if we renew leases, we are not supposed to do that in a non-carbon neutral building. So they either have to move out or we have to invest in making the building carbon neutral. We can do that either ourselves. We would expect, of course, rent abatements in return, or the landlord does it. And many of the landlords are very interested in retaining DHL as a tenant because it drives their value. So it's basically a balance of those. And if we develop ourselves, yes, as a standard rule, all our buildings have to fulfill those elements. And by the way, this is not restricted to putting a PV panel on the roof. It goes beyond that. It is also the social component in the ESG. So we take a particular focus on creating a nice and comfortable working environment for our people. Our people are one of our key focus areas. Without our people, we cannot operate. So the S is increasingly important. The government side of it, of course, is based on a strict regulatory frameworks that we see all over Europe. Right? We have to publicize our ESG performance in the report. So all of our board and all of our organization is being trained in doing that. But the real estate part of it is, yes, we need to benefit from cheaper power, from the PV panels. So in order to reduce cost, it's a big element. In Europe, it's kind of a hassle because there's no really one unified regulatory framework. It's every country is different. So in some countries we own the PV panels. In other countries we only lease the roof and give it to a third-party operator. And in other parts the investor does it. Yeah? And we can have some autoconsumption, some is fed back into the grid. So it's still a big cloud of things, and it will take a while, I think, to find the real way. And there's a geographical component as well, because in Southern Europe it's more easy to be carbon neutral because there's no heating in many of the buildings. And in Northern Europe it's a challenge because you have to reinforce the roof. We just completed a facility in Finland, and we had to invest considerable money in the roof, in enforcing the roof, not only to deal with the snow load, but on top of that also dealing with the weight of the PV panels. So it has impact.
Good. Let's do it, because I'm conscious of time, and coffee is waiting for us, I know that. So let's just do a quick, I'd be interested just to get from you, I suppose, what the biggest trend was of last year and what the biggest trend will be for this coming 12 months. You haven't had long to think about that, so I'm going to start with you, Doug. Let's start with you, and we'll work our way down, and you can judge.
I think the biggest trend for the Netherlands that we've seen in the past 12 months was rental growth and lack of supply. And I think the biggest trend that we will see across Europe following the Netherlands is going to be lack of power.
Okay.
Biggest, well, I don't know whether it was a trend, but it was something that we had to pay attention to is resilience in the supply chain, and making the supply chain secure. Going forward, I think the focus is very much on efficiencies in the broader sense of the word. So it's cost efficiency, but it's also to introduce digitalization in our warehouses. It's a big focus, automation, but also the robotics, artificial intelligence, digital twins. It's the whole lot that we have big teams working on that, but all with the goal to improve the performance and to reduce costs.
Okay, great. Cut.
Just on the investment side, I'd say it's the focus on interest rates and where they'll be over the next 12 months and how that will play into capital markets. And I expect there's a lot more competition in the capital markets, and volumes will increase as the cost of financing comes down. And you've already seen, as I mentioned earlier, some big players back in the market in a big way. And clearly they're taking a more forward-looking approach to investing. And I think many others, as FOMO starts to spread across the market, will follow that.
Last 12 months, as Peter said, the resilience leading to the 3PL outsourcing wave, which has been absolutely huge and really important for the market at a time when we've had this huge supply adjustment. So I think that's been really important. Going forward, market differentiation now at a sub-market level, we're just out of this blanket all improving environment from an occupational standpoint. I think who and which occupiers are coming back, where, and how that plays out would be really important. And on the investment side, for the next 12 months, unlevered returns looking really good right now, particularly in those core Western European markets. We touched upon it in terms of the CE, Western European side, but the likes of Germany looking very attractive with repriced yields, sensible levels of rental growth on top of that, and cost of capital, which I think allows investors to really start to come back into that. So for the next 12 months on the investment side, starting to see that depth emerge again in bidding terms, quite specific in terms of where it is and for what assets, but hopefully for that to build forwards as we move through this stage of the cycle.
Very interesting to see that a lot of the comments here as well within the panel have reflected what was actually in the census in terms of the views going forward. Teas and coffees will be next door. There'll be a chance to ask questions that you didn't ask during the session. Thank you to everybody here in the room. I look forward to chatting with you all afterwards. Thank you to everybody who joined us online. There will be, the slides will be shared, and they'll also be later also on our website to download as well. So you'll be able to access those. So all that remains is to say join us for a coffee, and thank you very much. Thank you, everybody.